Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money, because you know schools aren't. Don't forget to subscribe, so let's get started. So guys, in this video, I'm going to be going over some financial ratios, some popular ones that a lot of people definitely look at when they're looking at individual stocks, like how to value a company, if it's a good buy, or if you shouldn't even touch it. Now, I first want to give a quick shout out to Baby Investments. He's another YouTube channel. Great guy. He has a bunch of recent videos actually going over this type of stuff. You know, different valuations, different ratios. So I'll definitely leave a link in the description if you want to check out his channel. Awesome guy. But for this video, I'm going over my personal favorites of which ratios that I'm looking at. Now, all these ratios could basically be found on Yahoo Finance, or if you do some other type of website that gives you stock information, you could probably find it on that. Or if you want to kind of manipulate these equations, could kind of calculate it yourself. If you're into that, we're going to go over that. So the first one, main one that everyone really looks at, is a price to earnings ratio, or PE ratio. So many people look at it, guys. So this is looking at the price of the stock compared to the earnings of the stock. So this looks at the past performance, by the way. We have another one coming up next, but they say average. Of course, it depends on the type of industry, but throughout history, they show maybe fair or average could be around 15 to 17, maybe in that kind of area. So if it's higher than that, people see that as overvalued, and if it's lower than that, maybe even like single digits, it could be considered undervalued. Now, while doing this, I would definitely suggest comparing and contrasting different companies within the same industry. So I'm going to give you examples because that's how I learn. I don't know what anyone's talking about. I got to see some stuff. So I'm going to be showing you some companies that we all know, some credit card companies. So the first one we got going on is Visa. So we could see their PE ratio. We're going to have a bunch of other ratios later on, but their trailing PE, like we said before previously, what they had done for like last year, trailing PE is 33.35. Similar industry, different company of MasterCard, their trailing PE is just under 53, and American Express, their trailing PE is 34. So you can see all of these PEs are fairly high. They're definitely over 30, so that could be considered overpriced or overvalued. But if you're comparing these different companies, you could see that MasterCard was the highest PE, so that's the most expensive, versus Visa was the lowest, which was, I think it was 33. So now that's great and everything, guys, what the company has done, but most of us are interested on what the company's going to do. So instead of looking at a trailing PE, there is a forward PE. If you look at the word forward, obviously it's looking toward the future. Now remember, this is an estimate by like analysts and professionals and all that stuff. So it is an estimate. It's not like it's gonna happen, but this is definitely something more interesting to look at because it's for the future. So like we saw with these companies, they were overvalued. Their trailing PEs were over 30. Let's see what their forward PEs look like. Starting off with Visa, again, a little bit lower, forward PE of 25. MasterCard is at 26. And the last one that we looked at is American Express, which is much lower at around 12.6. So if you're looking at that, their future price per earnings, it's a lot more attractive for a lot of them. You could see American Express is actually the lowest. Now, I wouldn't suggest just looking at the PE like, oh, American Express is lowest, buy that right now. There are other factors which we'll be going into. But that kind of might weed out some companies like, oh, like MasterCard, it's kind of the highest, maybe not that right now. Now I want to show you a couple companies that, just to show you that PE ratios could go from like kind of undervalued to ridiculously highly valued if you're looking just at PE ratios. So right now we could see Disney, they have their 1 year chart right there. It's kind of been interesting to say the least with Disney. But you can see they have a PE ratio of around 14.5. So you could see they're possibly slightly undervalued, maybe in the fair valued category. Versus the exact opposite of Amazon, you can see their PE ratio is 260, which is disgustingly high, but you can see the 1-year growth chart is just as high as well. So use your judgment. A lot of value investors do not like investing in companies with high PEs like Amazon because it's expensive. So we got PE ratio, which I like looking at, forward PE ratio, which is what I kind of like looking at more than the regular PE ratio. Then the next ratio we're going to be looking at is the third one, which is the PEG ratio, P-E-G. Now the PEG ratio or PEG ratio stands for, like we said before, there was a PE ratio of price to earnings, but this also factors in growth, and usually it's like a 5-year growth. So it's comparing the price to earnings for 5-year growth. Now the lower that this ratio is, the more undervalued the company seems to be portrayed. So when you start looking and comparing different ratios, it could kind of help justify each other. So if there's a company with maybe like a higher PE, it's like, oh, that's kind of expensive. But if you factor in the growth to that, it might justify the high PE and it might be kind of attractive. So to kind of give you a ballpark, if you're looking at the PEG ratio, if you're looking under a 1, it's more undervalued. Around a 1 is more fairly valued, and over a 1 is overvalued. So to look at something real quick is Google. Again, I like my examples. Looking at all the ratios that we've been looking at, their trailing PE of 61, which is actually really expensive, but their forward PE is 23, so it's a little bit less, and they do have growth behind them, but their PEG ratio of a 1.4. So it's a little bit high at this point, but nothing horrendous. Like I think Amazon's at a 4, which is really high. So again, I would compare all of these ratios to multiple companies within the same industry to see which is more overvalued, which is more undervalued, and there might be reasons for that. Maybe some news related stuff, maybe earnings or whatever. Definitely do your research. And the last quick ratio that I like to look into, especially for dividend investors. If you like income and dividends, this ratio you should definitely look at, which is the payout ratio. So the payout ratio looks at the dividends versus the net income of the company. So how much of the net income is actually going back to shareholders? So basically, if the payout ratio is 100%, that means whatever the company's taking in of net income, 100% of it is going back out to shareholders. So obviously anything over 100% is definitely not good because they're giving out more than they're even taking in. So watch out for companies like that. You know, there might be companies 5, 10, 15% dividend. You're like, wow, that's incredible, but is it sustainable? So that's why I like looking at the payout ratio if it's sustainable. They say maybe anything under 75 or 80%. If it's anything lower than that, then it is safer. You know, you kind of want a little bit of wiggle room in there too. So let's go to more examples. Now, one of the biggest dividend companies out there, if you're a dividend investor, of course, this is definitely on like top of the charts out there, but is Verizon right now. Verizon is a telecommunication company, cell phones and stuff like that. A lot of people know them, a lot of people use them, but let's look at them. So you can see their dividend is around a 5%, which is very, very strong, all right? So looking past the few ratios that we looked at, their trailing PE is around 6.6, forward is around 10.5, and their PEG is 1.6. So looking at the PE, kind of undervalued. Definitely look at other companies, maybe look at AT&T as well. But going down to their payout ratio, this is going to be on the right side under dividends and splits. So going down, it says payout ratio of 30%. So that means it's very sustainable, guys, because they are only giving out 30% of their actual net income, which is very low. So if they need to increase, and they have been increasing their dividends over history, like a lot of dividend companies. I want to throw out, of course, Warren Buffett's one of his favorite dividend companies, Coca-Cola. He's been holding them for ever, since the beginning of time, basically. But another example that we all know, of course, I want to go over all the ratios that we've been looking at with Apple. Everyone knows them, biggest company in the world. You probably have an iPhone. So Apple right now, their trailing PE is around an 18. And by the way, Mr. Buffett has been loading up on Apple shares, so it has been climbing. But 18 is kind of in the fair valued position if you just look at PE. Their forward PE is a 14, so kind of undervalued there. And a PEG ratio of a 1.15. So that's still, you can see it's kind of in the fair market category. And of course, Apple has those dividends, of course. So that's why I like Apple so much. It has that growth, but it also has that sustainability. They have the dividends. So if it kind of stays still, you still get that income. So you could see, of course, the right side again under the dividends. Right now, they're around a 1.5% dividend yield. And their payout ratio is 24%, so very low. They have mobility to increase that dividend, and they will have no problem paying that out. So those were the main ratios that I look at, guys. Of course, there are other things as well, like different financials. I look at revenues, net incomes. I look at the balance sheet, some earnings. You know, there's a lot of things to go into it, so definitely do your research. Compare and contrast different companies, look at the company as a whole. And real quick, if you see like no PE ratio or even a negative PE ratio, that means the company's not profitable. Like Tesla right now has no PE ratio because they're not making any money. So keep that in mind when you're thinking of investing into a company. So those are the things that I look at, guys. If you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. And don't forget to subscribe to my channel, Real Life Money. I just started an Instagram account if you guys want to follow it. Link in the description. And thank you so much for watching, guys. So I'll see ya in the next one.